Last conferences, this next panel is constantly the hit of the entire agenda. It's a global reinsurance panel, the road ahead. So I'd like to bring up the panel moderator, longtime insurance executive with firms as varied as Travelers, Phoenix Home Life, AIG, and HSB Group, and currently vice chairman of Guy Carpenter. He told me just because I was a Canadian it was not Guy Carpenter and Company. Please welcome Richard Booth.
Thank you very much, Alan, for that kind and interesting introduction. You know, over the years, I've learned to listen very carefully to the words people use when they introduce someone. And last night, my wife was introducing me to someone at the cocktail party, and she referred to me as a model husband. Well, we've been married for almost 40 years, so I took that as an extreme compliment. And then this morning, as I was preparing my remarks, I happened to be looking through the dictionary, and I came across the word model. It's defined as a small imitation of the real thing. So I was going to refer to the panel today as model executives, but instead, I'm referring to them as distinguished participants. And I would like each of them to come up now and join me here on the stage. You have, I'm sure, read their bios, and you know that Henry and Tad and Marty have an extraordinary background and are, I think, well positioned to help us determine what's going on in the reinsurance market and what the road ahead looks like. You know, this is the first NICC that I've attended, and I have to say that I am very impressed, and I'm hoping very much to come back in the future. And I'm very proud, actually, that our company could be one of the many sponsors, because this clearly is a worthwhile and very valuable event. I recently joined the board of Sun Life Financial in Toronto, so I'm learning a lot about the Canadian system of regulation. And I thought this morning that the comments with regard to the regulatory overview were extraordinarily valuable and very comprehensive, and certainly were worthwhile to me. The Canadian regulatory system certainly is very proactive and is trying to add a lot of value to the entire financial system. You know, this morning when Joe made his opening comments, he talked about swans, and I thought he did it in a very appropriate and intellectual way. And I have to say that from an economic perspective, I see the shadow today of lots of swans. Obviously, the problem with shadows is you really can't tell what color they are, but I'm absolutely convinced that they're not white. To me, the present situation feels a lot like 2008, and that's a period that I lived through personally. 3 years ago at this time, I was vice chairman of AIG. I was asked to come down from Harvard Steam Boiler, where I was chairman, to work as the vice chairman of transition management associated with the federal involvement with AIG. So I lived through the last part of August, all of September, and the ensuing situation. And I can remember, of course, very vividly how close the U.S. financial system and the world financial system came to the precipice. And without the fortitude and the wherewithal of the U.S. Treasury to back AIG and a number of other financial companies, I think 300 in all, the situation we would be facing today would be a lot different and a lot more difficult. But, you know, as we look at the situation as it exists today, notwithstanding that the property casualty industry came through relatively unscathed and continues to be in fairly good situation, I wonder if we're going to be as lucky as we were the next time. You know, I've been in the industry now for 42 years, and I have to say that this is the most complex and concerning period that I've ever seen. And there's a number of reasons for that. The economic challenges throughout the world are extraordinarily serious, in my view. They're affecting a number of financial institutions, and they are affecting each of us in various ways. We have unprecedented correlated volatility in financial markets around the world. And that makes it very difficult for companies to strategically plan for the future and to make the appropriate investments. We obviously know that we have historically low yields with a continual reduction in reinvestment rates. And obviously that pressures companies that have long-term guarantees, it pressures pensions dramatically, and has a big impact on bottom line earnings. We heard this morning that a 1% reduction in reinvestment rates means that we have to improve the combined ratio by about 2.5%, and that's not easy to do in this environment. We also, as we look at our balance sheets, have uncertain values of financial assets, including especially sovereign debt. The banks in Europe certainly don't know how to value it now, and I don't think the international community does as well. We have tremendous stress in the global banking system, and the currency markets are showing it as well. And obviously there's a tremendous amount of pressure on liquidity, particularly dollar liquidity in the European banking system. There's a lot of confusion about whether we're in a deflationary environment or an inflationary environment, or maybe a combination of both. We heard at lunch and earlier this morning about the intense and increasing regulatory pressures, which require higher levels of capital, higher levels of expenses, and therefore much lower returns. It's obvious also that we have an accelerating slowdown in the global economy, and it has a big impact on the demand for insurance products as well as other products. 2011 has not been kind to our industry in terms of the magnitude of cat losses that we've experienced so far. And then, of course, we have a profound change in models and their wide-ranging implications on various companies. And I could go on and list a number of other risks and concerns I have, but it's a rainy, cloudy day, so I don't want to depress us all. But the point is that it's a really tough time to be a CEO. But today we are fortunate that we have 3 CEOs that are more than up to the challenge of what I've described as a very tough environment. So let's spend some time with them and see how they're dealing with these issues. Okay, well, the first item I think we're all interested in is what's going to happen with rates on January 1st. We've just completed the rendezvous, and there have been a number of meetings there and a number of observations, obviously. And there are a whole variety of counter trends in the marketplace that would suggest in some cases, obviously, that rates should go up. But we have other factors that would suggest that prices might remain roughly even. So let's really get into that issue with our distinguished panelists. And also, certainly, we invite participation from the floor. So from the standpoint of how we see prices now and what we expect from the standpoint of renewals on January 1st by major line, let's have some comments from the folks that have been at the rendezvous and from the participants as a whole. Maybe we can start with you, Ted.
Okay. Well, I think I read that Joel Baker had a headline that said the reinsurers have taken it on the chin, and I want to thank him for making the argument so succinctly. We have, actually. It's been a very difficult year. Cat losses have been very high. The earth has been shaking. The winds have been swirling around in the U.S. We've had droughts in Texas. We've had floods in Australia. We've had wildfires in Canada. And so there's been a very large series of large cat events. Through the first 6 months, it really seemed like every week it was going to be something new. You combine that with very low interest rates, in fact, record low interest rates, and an inability to generate decent investment returns. And as Richard spoke of, all the volatility in the economy and in the macro environment. We live in an age of substantial uncertainty and substantial risk. And when you put that together, it means that we need to focus as an industry on making sure that we're getting the right underwriting returns, the right underwriting profits. And that means making sure that we're charging the right rate for the loss levels that we expect and given the investment income that we think we can generate. With losses up, with investment income down, there's only one other part to that equation, and that's rate. And if we are determined to get to a level where we're generating an underwriting profit, we're going to need to raise rates. I'm not sure that this is a reinsurance-led phenomena. In fact, I'd say that this is a discussion that probably all of you are having in your own boardrooms. This is equally something that applies at the primary level.
Henry, what is your view of the situation?
Well, just to pick up from where Ted ended, it really lies at each of our feet. It's not unique to reinsurers to be the leader of any sort of a pricing adjustment. It's been a rough year. It started relatively slow, but seemed to have picked up progress pretty quickly. There's not one part of this universe that hasn't been touched by some cat event. In addition to the natural causes, we're also under a lot of regulatory scrutiny. We've been hearing this all morning. We've been hearing this over lunch. And so there's a fair amount of stress placed on institutions like ourselves to have cushion. Everybody speaks about cushion. But we also have to remember the lifeline of any corporation are its shareholders. Shareholders will invest in an endeavor if there is a proper rate of return. And I really don't see that proper rate of return this year in particular. So it shouldn't be a great surprise to see some adjustments going forward, which I think are badly needed, and we can't possibly avoid it if we are to maintain a sustainable enterprise for clients like yourselves who are looking for capital solutions. Our product should not be seen as simply a P&L item on an expense sheet. It is a partial capital solution to what your enterprise has to be undergoing going forward.
Marty, what's the view from Bermuda?
Well, I think it's a real tribute to the Canadian insurance industry that with all of these brokers and primary companies in the room, we made it till after lunch before we started talking about rates. And it's always the most popular subject, and clearly was a big part of the conversation at Monte Carlo. The news from any quarter is not much different than what you've read in your trade periodicals. Clearly, with all the cat events this year, property prices, most importantly, property cat prices are going up. 5 to 15% is the conversational range. Casualty prices are yet unmoved, probably not going down much anymore, but certainly not a lot of momentum on the upside yet. And it's a little bit perplexing as to how far does the industry need to sink in terms of its earnings or its return on equity before you start to get some consensus of action around adequate pricing. Most players in the Bermuda market, and I wouldn't think it's too much different in other parts of the world, probably this year, excluding the abnormalities of the cats, would have had a mid to upper single-digit ROE. Most our firms have a cost of capital of 12 or 13%, so not earning your cost of capital. We've had a year where we started the year and most folks indicated that they thought the industry was overcapitalized by $80 to $100 billion. Well, we've lost $70 billion in the first 9 months of the year, and yet there's no real sign of appreciable price strengthening across product lines. And it's really perplexing, and Ted's right, Henry's right, it has to change. I guess the question is in my mind, what is the compilation of conditions that finally tilts it towards change? Because as been said, we're not making any investment income. There's no place to put your money today to get any kind of reasonable return. Accident year combines on virtually every product line are approaching 100 or above. We're not earning any kind of an investor enticing ROE. If we were, these stocks wouldn't all be trading at 70% a book or 75% a book or 80% a book. So when are we going to have the collective will to basically earn not a usurious return, just a reasonable return for our product and our product line? Because the path we're on is unsustainable. You can't earn below your cost of capital for long till there's some type of price to pay. So I think change is on the horizon, but how fast and how quick, your guess is as good as mine.
There was a lot of speculation over the past few years that the reserve redundancy that was evident in many insurance companies was a major factor from the standpoint of the excess capacity that was in the market. Reserve redundancy seems to be running out, but the viewpoint is that the losses that we had in 2011 are more of an earnings event than they are a capital event, because the combination of earnings and reserve releases makes up for a significant portion of the cat losses. Do you think that the reserve position of the industry now is getting to the point where it's being somewhat strained? And if you do you believe that that might be one of the critical catalysts for a turn in the market? And maybe we can start with Henry on this one.
I think that makes for a good argument. It's like, rather than spending money out of your checking account, you decide to dive into your savings account and start depleting your savings account. Now, the purpose of the savings account is for the eventuality that there should be some sort of a disastrous situation, personal or otherwise, that an individual has to undergo. Our industry is not much different. I think we all practice relatively serious reserving methodologies. I think we're sound in that area, but we can't possibly be pulling money out of the savings account to be able to pay today's expenses. Yeah, there's an argument that I've read and most of us have heard that it stresses our income, but good income basically adds to the surplus in capital of the company. So yes, it may be viewed, may be argued as an income event, but if we're not improving the strength, the financial overall strength of the company, then we have a serious problem going forward. And again, to repeat the same comments that Marty made and I as well as Tad, it's not sustainable. We can't operate in that. That's not a good operating model to work under.
So as I look at this situation, I'm a little confused about one aspect of it, and that is there appears to be a lot of shadow capital that likes to move into this industry. And as we've seen some firming in prices, maybe particularly on the retro side, we've seen that there's been sidecar activity, other forms of capital. And it seems that given the pricing that's inherent in the marketplace, given the overall conditions, that it's a little bit unusual for capital to be ready to move into this industry. Now, Marty, you have a sidecar that's been set up. What is your view of the amount of shadow capital that potentially is available? And then to all the panelists, I'd really like to get your viewpoint on whether the ability of shadow capital to move to real capital relatively quickly is going to have the impact of holding down prices to levels that are really not appropriate for getting the right long-term ROEs. So maybe we can start with you, Marty.
Sure. Let me answer two things. I want to make a comment on your previous question, too.
Sure.
I think that the commentary that these have been earnings events rather than a balance sheet event is largely true. But you have had several companies go out this year and raise preferreds. Mm-hmm. And those preferreds have had 8 to 9% coupons on them. Well, at a time when your ROE is less than that, you probably wouldn't have gone out and raised those preferreds if you had not needed some capital. Mm-hmm. So that tells me that while we probably are in a period where these have been earnings events, we're on the cusp. And any event of any real magnitude from here probably is not an earnings event. It's probably much more of a balance sheet event. And for many of us, that's probably good news, because that means that prices will likely start to go in an upward direction. As respects the availability of capital, the capital that's available out there on a quick basis seems to have a very narrow focus and clearly wants the ability to move in and out with some alacrity. So it's mostly hedge fund money, some private equity money, and it really is in the property cat space. It's not anywhere else. Yeah. It comes into these special purpose vehicles. It underwrites for a year or 2 years, and then they're wound down and it leaves. I do think that if you're waiting on property cat to be the major catalyst for a broad market turn, it probably takes some of the edge off that being a reality. Because I think this new money comes in and quickly takes the pricing edge off property cat. I think at the moment, the fact that most lines of business are under stress probably helps make a broader market turn for the next period of up pricing more likely. But I don't think the opportunity for a sustainable market turn in the property cat space is very real, because I do think this short-term money will move in quickly, take the bloom off the rose, and exit as soon as pricing starts to go down the other side. It's opportunistic. We're a participant in it. There's no reason not to be a participant in it. It gives us some leverage on our existing underwriting operations, and frankly allows us to take on some volatility outside of our balance sheet that we really don't want to take on inside our balance sheet. So it's going to happen. You can't ignore it. You might as well find a way to take some advantage of it in your business plan. But in terms of overall economic health for our industry, I don't think it adds much.
Now, Ted, your company is one of the companies that did issue preferred stock to continue to strengthen your capital base, but you're with a very strong company. What was the sort of thinking that was involved from the standpoint of raising more capital at this point? And how do you view the whole issue of shadow capital and the impact on pricing?
Okay. Yes, we did. We issued preferred shares. We did that really to optimize the capital structure of the company. We did not have much in the way of hybrid or debt, and we felt that it was something that we had planned before we had actually these substantial cat losses, and it was also something that we felt was appropriate as we went into the wind season. We had been buying back shares up until that point, and really this was about optimizing the capital structure. I agree with Marty. I think that the impact of this just-in-time capital is actually quite material, quite significant. I think it's here for the long term. I think it is focused on cat risk, and I think it will actually change the dynamics in the cat market. The cat market has largely been a market that's relied on long-term pricing or payback, and historically prices have been quite volatile in the cat business. I think that you'll find that that volatility is dampened with this just-in-time capital, and will mean, in fact, that we have to get closer to the right risk price from day one, and that we can't sustain periods where price is below the adequate level. So I think, in fact, from a buyer's standpoint, I would say that this just-in-time capital is something that should actually be valued, because I think it should bring more stability to the pricing structure that we have for the cat business.
Henry, what's your view on this subject?
It's an opportunistic move. There's a tremendous amount of cash and capital available sitting on the sidelines. It tends to choose a time and a place when it wishes to enter. By far, the cat market is the area where you will find most of that activity. It's not in the normal running of the business affairs that you normally see it. It's specifically to that. So, I share both Marty's and Tad's perspective on it. It's quite correct, I believe.
Are there any questions from the audience on pricing before we move to another subject?
And I also noticed that the lawyers are not stepping up and making comments, which is unique in this country, unlike in the U.S., where
Yes.
the lawyers would make their statements first and then hold us in handcuffs afterwards.
Exactly. All right, so yes. So we have the microphone.
So we've got low investment yields. We keep hearing about that, but what I don't understand is why we don't hear about the cost of capital going down. These two things are linked in theory. Do you have any comments on why we're still talking about cost of capital in the high single digits or low double digits, even 15%. Why, if risk-free rates are so low, why don't we see people talking about cost of capital going down?
So the question is that obviously in a declining interest rate environment where yields are not really available to the same historic extent they have been in the past, as we look at the calculation of our risk-adjusted capital, why is that cost not really reflecting the current interest rate environment? I think maybe, Marty, you were the first one to actually reference that.
I would say that the cost of capital has come down. It's just a question of how far. And as a personal investor today, you'd probably feel pretty good at 8%, but it doesn't turn the equation in terms of the public investor. For years, the proverbial nirvana was the cross-cycle ROE of 15%. And if you read a dozen business plans for startups, 9 out of 10 talked about the fact that this was going to be a 15% ROE business. Well, interestingly enough, the risk-free return for most of that period was 5 to 6%, 4.5 to 5 to 6%. So we and several other companies have changed our target return, which somewhat reflects the cost of capital, to 10 over risk-free. So if risk-free is 2, we're trying to get 12. If risk-free is 3, we're trying to get 13. We think that's a more contemporary benchmark for these volatile times of risk-free. I mean, who's ever seen the risk-free rate jump around as much as it's jumped around in the past 2 or 3 years? I will say that on the equity side, the equity investor is still expecting that or more. But certainly, it's a double-digit expectation for equity capital of some magnitude.
Other comments from panelists?
Just that I would agree with Marty that you do need to look at the spread over risk-free these days, and it is something that we, when we're making individual decisions, we'll take a look at. We have maintained our target. Our target was not the 15. Our target was a 13 ROE over the cycle. If we were to feel that this was a step change in interest rates, it was going to be with us for a number of years, we might well change our long-term target. But at this point, with the uncertainty out there, it feels right to stick with something that has been a grounding for us for a long time now.
Henry, from the SCORE perspective, any change in the way you view your cost of capital?
We've reduced it a bit, I think, to reflect reality. It's not just an issue of contemporary, it's an issue of reality. So we'll also look at it over the cycle. It's not a one-year event, so we'll look at it over a 3 or 4 year event situation and get that required return. Again, always in the interests of the shareholder, because the shareholder has to be rewarded.
I think it's a very good question.
Yeah.
It's a very good question, and I think one of the other elements to think a little bit about is what is risk-free today, and is the risk-free rate artificial or real? In the past, the risk-free rate has been set by the market. Today, the risk-free rate is set by the central banks. And I think if you adjust for the artificial nature of the risk-free rate, you actually would find that your true cost of economic capital hasn't changed that much. As a matter of fact, it might actually be going up in a variety of scenarios that you could contemplate. But it's a great question. Any other questions on the pricing environment? All right. Let's talk a little bit about how companies are trading. We've already talked about the fact that most insurance companies, reinsurance, primary insurance companies are trading below book value. There was an interesting commentary that came out while we were in Monte Carlo that suggested that one of the main reasons that companies are selling below book value is because they have emphasized diversification as opposed to specialization. I know there are a number of other issues associated with this question, but how does the panel feel about the relative merits of diversification, perhaps when scale is not achievable, versus specialization. And maybe we can start with you, Henry.
Thank you.
We didn't rehearse that one, so.
Yeah, you did say you were going to pick on me, so that's fine. I mean, the standing philosophy at SCOR has been, always is, and will continue to be diversification, both geographically, product line. We withstood a lot of stress, I guess, during the period of 2003 to 2005-06 from rating agencies and other organizations that questioned the logic that we refer to as old school. We were referred to as being totally disconnected with reality, and the beautiful model was the monoline model. Well, over time, the rating agencies have sort of come back and agreed that maybe they weren't right, which is quite a unique situation when you get an agency telling you this. So we continue to believe that that is the correct methodology, that the methodology of diversification spread your personal income, you spread your personal financial situation. Spread is not a bad thing. It is a good thing. And we're committed to it.
Ted?
Clearly, diversification is a cornerstone of our strategy, and it will continue to be. And really, the way we view diversification or the importance, let me say, the importance of diversification has not changed. We're in the business of assuming risk, and we'll assume that risk if we get paid for it. And that would suggest that we're getting some incremental value from it than our clients. And so what that suggests is we're doing it because we can manage the risk better than our clients can, and we do that through diversification. Now, we have never subscribed to underpriced or diversification without profit. Diversification without profit is not beneficial. You need to ensure that you're adding incremental profit as you diversify. So it continues to be a cornerstone. I don't know how you could be in the global reinsurance business if you didn't subscribe to diversification.
Mm-hmm. Let me put a little wrinkle on it for Marty. You know, in the past, diversification was looked at uncorrelated activity, and therefore it would balance out your portfolio in ways that would, over time, provide incremental return. There's a theme that's starting to occur on a global basis that risks are becoming a lot more correlated, and therefore diversification doesn't act in the same way in terms of providing marginal returns. What is your view on that, Marty?
A few thoughts. As for correlation, I clearly think the view that the asset side is becoming more as opposed to less correlated regardless of your asset class proved itself to be very true in 2008 and seems to be proving itself to be somewhat true in the current year. I'm not so sure I feel that way on the liability side of the equation. I think the diversification of non-correlated liability risk creates a stronger, more consistent, sustainable enterprise. I mean, clearly you need to price them at a profit. You're getting a perspective up here from 3 diversified writers, so we probably need one of the property cat players on the stage. But I'm a big believer that the investor values consistency over time. The property cat specialty writers have had a good run, 06 through 010, because there just haven't been very many big events. And if you're writing property cat monoline and you don't have any losses, it's a pretty good business. Probably not as good a business in 2011, depending upon where your risk was. I read the article you're referring to, and I was somewhat surprised that they came out in that position. Clearly, it flies in the face of what the rating agencies have been promoting for the last few years. I really think the present valuation issue has very little to do with diversification or specialization. I think it really has to do with basic economics. And when these firms were fairly consistently earning a 15% plus ROE, they were trading above book. Now when you're earning a high single-digit ROE, you're trading at 70 to 80% of book. I think it's just math. And until you can get back to providing the equity holder with an ROE somewhere close to what they think their cost of capital is, whether that's 12, 13, 14, whatever it is, then I think you're going to be in this below book purgatory, which makes everything else tougher.
Let me just say that I think even within the property cat segment, the property cat specialists do build their model by and large on diversification. And one of the things that I think is a challenge, and one of the things that we as an industry need to think more and more about, is the tail risk and how you really diversify tail risk on take a portfolio of earthquake. Can you, if we have, let's say, 5, 6 earthquake zones around the world that buy substantial limits of 30 billion or so, can you really manage a diversified portfolio, certainly an earthquake portfolio, with a spread of 5 or 6 risks? It becomes, obviously, within earthquake itself, not practical. I think the value of diversification really, I have a hard time challenging it. The execution of diversification and how you actually attain it is a challenge, and is those who do well win.
Good points. Any follow-up from the audience on this subject? Okay, so thinking about economics and the belief that in the end economics prevail in terms of decisions that people make. If we look at the M&A situation right now, from the standpoint of actual transactions and activities, it's been a fairly significant year. I think there have been about 290 transactions worldwide. About 44% of those have occurred in Europe. The big one that everybody's watching right now is Transatlantic and Validus, and the rumor today, or I guess it's fact, that there's an unnamed new suitor that might be in the picture. Well, that's obviously a large potential transaction. But if we look at the economic situation impacting the industry, we've already talked about the fact that insurers are not earning their cost of capital. We've talked about the fact that they are selling below book value. We know that the regulatory regime is changing, and with that comes increased levels of capital and more expense. And we know that there's a lot of capacity in the industry, both real and potentially available from other providers outside the industry. So the question obviously is, which we've asked for probably 30 years, what is holding up consolidation in the industry? Do you think there will be significant consolidation, and what do you think the catalyst will be? And perhaps we can start with Henry on this one.
Thank you.
You get all the easy ones, Henry.
Yeah, I noticed that. Thanks, Marty. I mean, what are the drivers? I think each organization has its drivers for wanting to do a consolidation or do an acquisition. Market share, market presence, taking control of a particular pricing environment if that's possible. What are they going to continue? They probably will. At the moment, if you're rated at about 70% of book, maybe it's an interesting time to put money on the table and pursue it. It's a phenomenon that I believe will continue onward for whatever reasons each entity pursues it. I certainly don't want to make comments about what goes on Transatlantic or Validus. I'm not familiar with the internal arguments, and I don't think this is a venue for that sort of a discussion. However, we should be seeing some of these transactions. Whether they're going to be larger or smaller is to be seen. I think virtually everybody's up for sale at some point in time. If the price is right, why not? As you well know, we did a transaction on the life side, and that was basically positioning from where we took it. So that was the reasoning behind our move. Will it continue? I suspect it will. I'd be surprised if it didn't.
Ted?
Yes, I believe that there are compelling reasons for further consolidation. I think there actually has been a substantial amount of consolidation over the last 20, 25 years, certainly in the U.S. reinsurance market. I think those reasons are really quite compelling now. You mentioned them. Increased compliance costs, more volatility in the business that's ceded to us. Our clients are retaining more and more of the ballast, more and more of the diversifying business, and looking to cede more and more of the volatile business. I mentioned already tail risk. To absorb that requires a larger balance sheet. I think the uncertainty that we have in the economy these days also suggests that having a larger capital base is a good thing to do. Hopefully, we'll be able to put that capital to use. But yes, I think there will be continued consolidation. I think that the challenge right now is actually over the valuations. I think it is very difficult. We saw with the transatlantic transaction that it's really very difficult to put yourself into play at 70% of book value, or I guess even lower. I think there was 60% of book value. Put yourself in play at that level, and then when an offer comes in for something a little bit higher on a basis that's maybe not as strategic, it's a very difficult thing to do. So I think executing right now is more challenging. Marty's certainly had experience.
He's had experience.
I would echo, there's probably been no tougher period in my industry career to execute M&A. We've lost the ability at the moment for the natural buyer and seller. Trading multiples are so compressed, almost regardless of the financial performance of the firm, that there's no ability to pay a premium or no ability to do anything other than these relatively all stock for stock, book for book kind of combinations, which then no longer are mathematical exercises. Those are social exercises. Do you have the same strategy? Can the boards get aligned on where you ought to go? Can you figure out how to bring the two management teams together, et cetera? Very, very, very tough combinations that take a lot of conversation and a lot of thought, and more recently are somewhat challenged by the actions of the proxy advisory firms. If you're a U.S. publicly traded company, these proxy advisory firms are going to express an opinion as to how you should vote on the merger, and they seem to be saying that if it's an all-stock deal, that one of the parties has had an obligation to shop it, to see if there's some higher bidder out there. Well, it sort of flies in the face of a book-for-book, stock-for-stock deal that theoretically is creating a new and better company. It's not a shopping exercise. It's more of a strategic exercise. So you're back to the equation of can you align two firms where there can be a natural buyer and a natural seller, the seller typically getting some premium for their assets and the buyer having some vision as to how they're going to put that to work. I think it's very tough at the moment. Clearly, we're in a period when M&A, in my opinion, would be beneficial for the industry. I think we have too many players doing roughly the same thing that are roughly the same size, and ROEs are suppressed. And to the extent that M&A would help bolster ROEs in the resulting firm, I think that would be good. But getting from here to there, I think, is problematic.
We also have one other element, and that's the too big to fail syndrome. Regulators and governments are really stepping up their watch over that particular phenomenon. And I think a lot of companies are very, very large, are being forced to explain why they shouldn't be in that particular category. So that's another added feature that we have to sort of be conscious about.
That's a good point.
Yeah.
Any follow-up from the audience on this subject? Okay, then let's turn to models. There's been a number of changes in models in the U.S. and in Europe. We won't go through necessarily the details of those, but they've had various impacts, very widely varying impacts on companies, of course. I think the audience would be very interested in getting your perspective from the standpoint of how these model changes impact how you manage the risk profile of your company, how you take them into account from the standpoint of pricing, whether it changes your capital allocation methodology in any way, and whether there are any rating agency issues associated with it. And perhaps, Tad, we can start with you this time.
Sure. Yes, we do use models, clearly. They are important to us. We are, I think, generally in a more fortunate position than maybe the majority of our clients are, in that we don't have to rely on them solely for risk management. We're in a business where almost 80% of our cat exposures come with limits attached to them. And so we can merely add up our limits and make sure that we're not taking too much exposure on a limit basis in any one zone. So that gives me a great deal of comfort that, in fact, we've got a fail-safe methodology for risk management. For pricing purposes, we do rely on the models, and I think it's I am one who's more comfortable using models for pricing than for risk management, and that's essentially what we do. I think the challenge with models is there's a balance, a trade-off between consistency and accuracy. Models are very effective for relative purposes. So to look at an exposure over time, 1 year to the next year, they're actually, I think, quite valuable. That presupposes consistency in the model, and what we're seeing now is a lot of changes in the models. And we're also, I think, questioning the accuracy. So we're neither getting consistency nor accuracy. And that, I think, is really at the heart of why there's really so much discontent right now around the models.
Henry?
Yeah, I totally agree with Todd. I mean, trying to understand what the message is and using the newer models is truly a mystery and mystical almost in some cases. And there will be some resistance as to what the ultimate result will be. In our case, it's less of maybe of a pricing phenomena and more of a risk management tool, because it allows us to understand where our aggregates are and get a much more precise reading about the exposures, and it does help. But I think that in the more recent versions, there is some controversy as to what it creates. Particularly for a European-based company, we also look at the impact that Solvency II is going to have, and that is really, quite a gut-wrenching state of affairs, because insurers in Europe are really, fighting the process. We'll see where it all ends. The benchmark seems to be moving a year further. Now it's in 2014, so we just keep moving forward because we can't seem to get a consistent approach on the matter. So it'll be interesting how these two combine into the perfect storm scenario at some point.
Marty, let me just spin it slightly differently for you. I know that boards of directors have become very aware and very personally interested in risk management. I know there are some boards who are shocked by the different risk projections associated with the new models relative to what they thought their company's risk position was. How do you deal with your board and other constituencies from the standpoint of explaining how risk parameters can change so significantly in a relatively short period of time without significant events necessarily being the trigger?
Well, I guess from the introduction, we should let them know that models are small and insignificant or something like that.
That's perfect.
Reinsurers have not been quite as adversely impacted with the recent model changes as primary insurers, because most reinsurers were already multi-model firms, both the publicly purchased models and the ones that you build in-house. And our job is to use the models not as the end point, but to use the models as the starting point and then apply judgment around the models. So most reinsurers haven't had quite the internal impact on their own book of business that you're hearing about from the primaries. The primaries, on the other hand, an awful lot of them are single model firms. And depending upon which model they choose to follow or which model's being updated at that point in time, the impact can be quite severe. And in Europe, compounded with what Solvency II is bringing to the table, it's really a very different ballgame in the capital that's required for your business. So you either raise more capital, buy more reinsurance, or write less exposure. Now, we're typically talking about cat here. That seems to be where all the model controversy seems to fall. From a board's perspective, the boards really do focus in much more on the end result than they do in what went into the process to get to the end result. At the end of the day, you're showing them what is your 1 in 250 most severe event that's out there, or what's the combination of them. And if nothing has happened and those events have moved meaningfully, it is a tough board conversation. And particularly a tough board conversation if the answer is, we're not sure we trust the new model. You know, the model's changed so far, so fast in one version update. Is the next version update going to temper that or go back the other way? And so I think at the end of the day, it does place a lot more burden on your own internal competency, the own internal skill set of your actuarial team, your risk management team, and your database to apply your judgment to the models. Because the models are terrific, but they're not the end, they're the beginning. I talk about them in our company. They're a 9-iron in your golf bag. You don't use the 9-iron on every hole, or at least you're not supposed to. and so I think that in some ways this too will pass. I think the models get increasingly credible with each event that takes place and with the data that's generated out of those events. And by and large, I think they're very helpful to our industry. You just have to make sure you're putting some judgment around the models.
Any follow-up from the audience on those comments? Okay, we'll move to another subject. We only have 2 left now at this point. Some forms of reinsurance are being securitized into the financial markets. Some people feel that trend is going to increase over time, and others aren't necessarily sure. But from the standpoint of how you look at the ability to enter into insurance-linked securities transactions or other forms of securitization on the reinsurance side, what are the factors you consider, and how do you see that market developing over time, Ted?
Well, I think it's just one of a number of tools, really, that have been developed over the recent past. And in terms of actual ILS, I think it's still actually fairly time-consuming to put together. I think this just-in-time capital that you can achieve through sidecars will actually probably dampen the growth of ILS itself. I think also in terms of the buyers of ILS, I think there are other mechanisms that they've now found that allow them to participate in the industry, such as ILWs rather than ILS, and also just collateralized reinsurance. So I think the hedge funds and pension funds will continue to buy cat bonds, ILS, but I think that with the advent of collateralized reinsurance and funds that can trade in ILWs and sidecars, the actual growth of the ILS segment itself will not accelerate dramatically.
Thank you. Henry?
It's another tool.
Yeah.
It's another tool in as much as contingency capital is another tool. It operates in a specific metric fashion, which is fine. When we purchase retro, it's important to us. We have a series of options now we can choose from. We certainly don't expect retro to be inexpensive going into the 2012 season. I think we'd be foolish to believe otherwise. And you have to temper with different solutions in place and sort of use the market forces to try and do this. And I think the broader the choices, the better the industry will be at the end of the day.
Marty, do you think there'll be accelerating innovation in these areas, or do you think the market's about where it will continue to be for the foreseeable future?
I would tend to concur with Tad and Henry. I think that the ILS market gets an incredible amount of publicity for the magnitude of premium or exposure that's really encompassed by that market. And so I think it's an interesting tool. I think it lends itself to the property cat world fairly well, where there's good established models and metrics in place. I think most lines of business in our industry don't have that feature. And so therefore, I think people struggle to take ILS beyond property cat, and probably rightfully so.
Well, let's end with some commentary on how our panelists feel about the Canadian market, the importance of it, what sort of pricing actions might be coming in the future. Perhaps we can start with you, Henry, on that.
Well, all you have to do is look to see how many new players have come into the market in the last few years. Obviously, the global marketplace views Canada in a very positive fashion for whatever reason you wish. Pricing-wise, it's not an infinite market, it's a finite market. It's not the largest market in the world, and so there's going to be continuous pressure on pricing. But let's also not fool ourselves. I mean, the price, there has to be a certain price per product. Otherwise, capital looks elsewhere. We work in a global organization, and therefore there's competition within our own organizations as to where to allocate capital. And so we have to be able to produce as an entity a decent return to make it worthwhile. But certainly Canada continues to be an attractive place for new enterprise.
Marty, I know you're active in Canada as well.
Yeah, we're a very small player in Canada compared to Tad and Henry. The Canadian market, in my prior life, I had some dealings up here and some modest dealings with Alterra today, is a terrific market. It's a very stable market. It probably, in the financial sector, is the envy of most of the world today in terms of how it weathered the 2008, 2009, 2010 issues. 2011's too fresh baked, so I'm not sure you get credit for that yet in terms of how you weather that. And I did take a little tour around Vancouver yesterday, and wish I could afford to buy a condo here. Jeezy peasy, the prices they're just out of reach. But we enjoy doing business in Canada and would love to find ways to do more.
Canada is an important market for us. It's a mature, sophisticated, well-managed, well-regulated market. If I were to say that there was a challenge, it would be around balance. I think as a reinsurer, the reinsurance market has contracted over the recent years. And again, clients are ceding more and more in the way of volatility and retaining more and more of the less volatile business. As a reinsurer, that leaves us subject to volatility, and achieving balance within the portfolio is difficult. I think if you were to extend that to the tail exposure here in British Columbia, I've already talked about how I think we as an industry are reevaluating what kind of diversification you can get from tail exposures, or how you can diversify tail exposures. And I think that's something that is really very pertinent here as we sit here in Vancouver.
Any final questions from the audience? If not, I thank you very much for your, yes, couldn't see you with the light, actually.
More of a comment, I think, on the Canadian market, but the other trend that I've been watching in the Canadian market, and I'm not sure if this is your thoughts on it or not, but I've certainly seen a lot of insurance companies getting into the reinsurance area and some reinsurance companies getting into the insurance area. So that's kind of something that I've been seeing happen, I think, in terms of capacity. There's a lot of capacity in the Canadian market, I think, in terms of your comments on consolidation. Boy, it certainly seems like a lot of companies are diversifying their products offered. And so anyway, that's also a trend that I've been seeing in the Canadian market, and I'm not sure where that will lead to.
Our business of the three companies up here probably is the most diverse between insurance and reinsurance. We're 60% reinsurance, 40% insurance, mostly specialty insurance. I guess the only comment I would have is the insurance business is today kind of a dog-eat-dog business. The reinsurance business is just the opposite.
Anybody want to take on the subject any further?
I like Marty's analogy.
I think so. That might be a
really
good end
apropos.
Might be a good place to end, actually. So, thank you very much. It's been a pleasure to be here. I hope this was helpful to you.
I want to add to that and thank you for some very thoughtful and candid conversation. It was like listening to 4E=mc² guys. Very impressive. Very good. We're going to take another break for half an hour, sponsored by CI Top Broker. You should also know that the WIC silent auction is starting. As an inducement to generosity, we also are providing Haagen-Dazs ice cream outside. So we'll ask you to come back, hopefully not in an ice cream coma, at 3:15. Thanks a lot.